All right, so you're ready to dig into Hindware Home Innovation's latest earnings call. You've got the documents, but you want the key takeaways, right? Like
Yeah.
what actually happened and what it means for investors.
That's what we're here for. We're going deep. We've got the conference call transcript, we've got the investor presentation, and we're ready to break it all down.
Let's do it.
Hmm.
We're talking Hindware Home Innovation, a big player in India, a really well-known Hindware brand.
Yeah, they're all over the place. Building products, consumer appliances, everything from bathroom fixtures to pipes to kitchen appliances.
Yeah, they've got a long history. But this deep dive, we're focusing on their performance in Q2 and the first half of FY25.
So what did management have to say? What does it all mean for investors like you? Let's get into it.
Okay, let's jump right in.
Well, to be honest, Q2 was a little bit lackluster.
Lackluster, huh?
Yeah, revenue came in at 630 crore for the quarter
Okay.
and 130 crore for the half-year mark. EBITDA, that's earnings before interest, taxes, depreciation, and amortization.
A mouthful, I know.
Basically, it's a way to measure their operating profitability. Anyway, EBITDA was at 40 crore and 95 crore, respectively.
So not great, not terrible.
Right. It seems like the tough market conditions out there and also their own internal restructuring efforts, they're both playing a pretty big role in those numbers.
Okay, interesting. So let's break it down. Let's start with their building products business. What's happening with bathware?
Well, the bathware segment as a whole, yeah, it's a little sluggish, but their faucet business, actually, that's showing some good momentum. People are still upgrading their taps even when the market is slow.
Okay, so faucets are a bright spot. But overall, bathware revenue actually declined by 9% in Q2. And that's with shrinking margins.
Yeah, so the CEO pointed to the internal restructuring they've been doing, merging teams, they're consolidating warehouses, streamlining the entire service operation.
Big changes.
Yeah, and it just so happened to coincide with, well, the market kind of took a downturn, so it's like a double whammy.
It makes you wonder if they're losing ground to competitors, right?
Yeah.
I mean, if everyone's facing a tough market and their numbers are down, is that a red flag?
Yeah, definitely something that analysts and investors are watching closely. I mean, the CEO insists that it's just a temporary dip. They expect a bounce back, but there have been concerns.
Yeah.
Some dealers have voiced worries about Hindware's after-sales service
Uh-oh.
and also about their pricing strategies. They're calling them schemes, those short-term promotional discounts.
Okay, so dealers are a little concerned. What does that mean for investors? Are these concerns impacting sales?
Well, the CEO claims their secondary sales are better than the primary sales numbers might suggest.
Secondary sales. Hold on. Break that down for me.
Sure. Secondary sales, those are what distributors are selling to retailers.
Got it.
So that means product is actually moving.
So maybe there's like a bottleneck somewhere in their distribution, potentially due to the restructuring.
Could be. Hopefully it's just short-term pain for long-term gain.
Let's hope so.
Yeah.
Okay, so bathware, it's been a bit of a roller coaster, it sounds like. What about their other building product? The pipes and fittings. That's their TrueFlow by Hindware brand, right?
That's right. And it's a different story over there. They're actually seeing some pretty strong volume growth.
Nice.
Yeah, especially with their CPVC pipes. Actually, volume grew by 11% year on year in the first half of FY25.
Okay, so some growth. There's always a but, right? What's the catch?
Yeah, well, raw material prices, right. They've been kind of all over the map, and that's going to have an impact on the overall revenue growth for the segment.
Right. Even if they're selling more pipes, those price fluctuations can really cut into their gains. A classic supply chain headache.
Exactly.
Okay, but are they just kind of sitting back and taking it?
Yeah.
Or do they have any kind of plan to deal with this raw material volatility?
Oh, they're not sitting back. They've got some expansion plans. They're building a new plant in Roorkee. It's supposed to be up and running by the end of FY25. Yeah, the initial revenue target for the plant is 160 crore. And they're projecting an 11% EBITDA margin, assuming current PVC prices hold.
So big bet on pipes and fittings continuing to grow.
Yeah.
And they're not stopping there. They're launching new products too. Foam core pipes for underground drainage, double wall corrugated pipes. They're even getting into fire sprinkler systems.
It's a good strategy. They're diversifying their product portfolio, reaching new customers, and not putting all their eggs in one basket.
Right. Okay, building products, check. Let's move on to their consumer appliances business. How are things looking on that front?
Well, revenue declined in Q2, mainly due to weakness in their kitchen appliance segment.
Oh, no, not the kitchens. Everybody needs a good kitchen. What's going on there?
Well, it seems the segment is currently unprofitable.
Mm.
Yeah, which of course is not what investors want to hear. Management says they're prioritizing profitability over growth for the time being.
Okay, so maybe sacrificing some top-line growth to get those margins back on track. What are they actually doing to make this happen?
Well, a few things. They're merging some of their back-end operations with the building products business.
Okay, so cost cutting.
Exactly. And they're cutting out some unprofitable product categories and SKUs, and they're really focusing on their higher margin kitchen business.
So some belt tightening over the consumer appliances division. But anytime a company starts talking about cost cutting and merging operations, there's this big question that always pops up.
Jobs.
Yeah.
Yeah. And in this case, the restructuring has, unfortunately, it's affected over 350 jobs across the company.
Always tough to hear about job losses, but often it's a part of these big transformation efforts.
Hmm.
Okay, so we've covered building products, we've talked consumer appliances, but let's zoom out. Let's look at the big picture of their financial situation. One thing kind of jumps out at me.
The debt.
The debt, yeah.
Yeah.
It's increased significantly from FY22 to FY24. Any savvy investor knows rising debt, that can be a big warning sign. What's the story there?
Well, the increase is largely due to a slump sale transaction they did back in FY22 to buy their manufacturing units.
Right. They used to be purely a trading company, buying products from a third party. And investors, a lot of them weren't thrilled with all those related party transactions.
Exactly. So they took on debt to bring manufacturing in-house.
Made sense strategically, but it definitely added to their debt burden.
Yeah.
And now they're using proceeds from their upcoming rights issue to try to pay down some of that debt.
Right. A rights issue, for those who don't know, that's basically when a company offers existing shareholders a chance to buy new shares at a discounted price.
Got it.
Helps raise capital without relying on external financing.
Smart move. If they can pull it off, it'll help them deleverage without taking on even more debt.
Agreed.
Okay, so debt is definitely something to keep an eye on. But let's shift gears a bit. Talk about management's outlook. What are they saying about the future? After all, at the end of the day, investors are betting on the people running the show.
Right. So they're acknowledging that the current environment is tough. Not a surprise, but they're optimistic.
Optimistic
About the future. They think the restructuring efforts they're doing, and also just an eventual market recovery, that's going to lead to better margins and improved performance in the coming quarters.
Classic CEO message. We're facing headwinds, but we've got a plan. It's up to each investor to decide if they buy that optimism, though.
Right.
Because one thing's clear, Hindware is in a transition phase. Big time.
Absolutely. Big moves to streamline, reduce debt, position themselves for growth in the long term. Whether it all pays off, though, that remains to be seen.
Okay, so before we move on, I want to go back to the building products business for a second. There was a detail about the dealer concerns, over faucet pricing, the schemes. We need to unpack that a bit more.
Yeah, good point. We touched on it, but it's worth diving deeper.
There's a reason they haven't been able to fully pass on those increased brass prices to consumers.
It comes down to competition. Jacquard, big player, huge. Yeah, they haven't raised prices at all.
So if Hindware gets too aggressive with their pricing, they risk losing even more market share.
Exactly. It's a tightrope walk. They need to protect their margins, but they can't afford to, upset their dealers or lose customers to the competition.
It's a tough spot to be in for sure. Okay, so bathware, definitely some challenges there. But let's talk about something a little more positive, cost savings. Hindware has been working hard to optimize costs and be more efficient.
Yeah, they set some ambitious targets.
They did, something like INR 20-25 crore in cost savings.
Right, but it's not as straightforward as it might seem.
Oh.
It looks like those savings won't translate directly into lower expenses.
Why not?
Inflation.
Inflation. The silent profit killer.
Exactly. They've cut costs in some areas, but they've also had to give employees raises to keep up with inflation. So the net impact on their expenses might be smaller than they initially hoped.
2 steps forward, 1 step back.
Pretty much. But it's not just about cutting costs. They're making changes to improve operations. For example, they've done a really good job with working capital management.
Remind us what working capital means again.
Of course. It's basically the cash a company needs to run its day-to-day operations.
Okay.
So the fuel in their tank.
Got it.
And Hindware has been optimizing that. They've extended payment terms to suppliers, so they're holding on to their cash longer.
Gives them more flexibility. Do you invest in growth or pay down debt?
Exactly.
Okay, so working capital check.
Yeah.
But even with these improvements, they're still facing some serious headwinds, right?
Right.
We talked about the tough market, but there's also the debt.
Yeah, it's a real concern for investors. We talked about the debt they took on to acquire those manufacturing units.
Back in FY22.
Yeah, and are hoping the rights issue will help with that, but it takes time.
So what's the big picture here? What are investors supposed to make of all this?
I think Hindware's at a crossroads. They've got some big challenges, the market, costs, debt, but they're also making moves to address those challenges.
Restructuring, cost optimization,
Right.
debt reduction.
Right. So it's a bit of a wait and see situation for investors. The next few quarters will be crucial.
Yeah, it'll be interesting to watch how it all plays out. We've given everyone a lot to chew on today. But before we move on, I want to go back to the point about sustainability. I think this is an area where Hindware has a real opportunity.
Yeah, definitely worth exploring.
Consumers are way more aware now about, the environmental impact of their choices. And investors, they're looking for companies that prioritize sustainability.
Absolutely.
And Hindware, they're in the business of making products that are essential.
Yeah.
Bathroom fixtures, pipes, appliances. So if they can become known for making eco-friendly versions of those things,
That's a good point.
that could attract a whole new set of customers.
Yeah, people who are willing to pay a premium for sustainable products.
Exactly. And it's
Yeah.
not just consumers. There's this whole trend of ESG investing too. Investors are looking for companies that are committed to environmental, social, and governance principles.
So Hindware can really attract a new wave of investors if they can show a strong commitment to sustainability.
It's a win-win-win, right? Good for the planet, good for conscious consumers, good for ESG-focused investors.
Definitely a compelling idea for them to think about.
Okay, so as you continue to research Hindware and consider their potential, dig into their sustainability strategy. What are they doing to reduce their impact? How are they engaging with stakeholders?
What are their goals? All important questions to ask.
Absolutely, because the answers to those questions could give you a lot of insight into their long-term prospects.
So we've been digging into Hindware, their performance, their strategies, but what does it all mean for their profitability? That's the big question, right?
Yeah, we've talked around it, but let's get specific. What about earnings per share? How is all this impacting that?
Right. Well, to really understand that, we need to look at their overall cost structure and all these efforts they're making to be more efficient. Remember those cost-saving targets they set?
Yeah, like INR 2025 core and savings, right?
Yeah.
But you said inflation was kind of eating into those gains.
Exactly. They've achieved some cost reductions, but then they've had to increase salaries to keep up with inflation. So the net impact on their expenses might be less than they hoped.
2 steps forward, 1 step back.
Kind of, yeah. But it's not just about cutting costs. They're also making changes to how they operate. Working capital management, for example. They've done a great job there.
Working capital. Remind me what that means again. Sometimes I get those financial terms mixed up.
Sure, working capital is basically the cash a company needs just to run its day-to-day operations.
Got it.
Think of it as the fuel in the tank.
Okay.
And Hindware has been optimizing that. They've extended payment terms to their suppliers, so that means they get to hold on to their cash a little longer.
More cash on hand to invest or to pay down debt.
Right. And they're also trying to optimize their inventory, making sure they have enough product without tying up too much cash.
So it's all about efficiency, getting the most bang for their buck.
Exactly.
But even with all those improvements, there are still headwinds. We talked about the market, but their debt levels are still a concern.
Right. We talked about the debt they took on to acquire those manufacturing units.
Back in FY22.
Yeah, and while they're planning to use the proceeds from the rights issue to help with that, it's going to take time.
So where does that leave investors? What's the takeaway?
Hindware is at a crossroads. They have challenges, the market, costs, debt, but they're taking steps to address all of those.
Restructuring, cost-cutting, paying down debt.
Right. So investors have to decide, do they believe in Hindware's long-term potential?
Kind of a wait-and-see situation.
Exactly. The next few quarters will be telling.
Okay, a lot to think about. But before we wrap up completely, I want to circle back to the sustainability thing.
Oh, yeah. Good point. We didn't really have time to dive into it today.
Consumers are so much more aware now about the impact of their choices.
Right.
And investors, they're looking for companies that are walking the walk, not just talking about sustainability.
And for a company like Hindware, making things that people use every day, they have a real chance to lead.
Yeah, bathroom fixtures, pipes, appliances. What if they're known for the eco-friendly versions of those things?
That's a great
They
point.
could attract a whole new type of customer.
People who are willing to spend a little more for products that are sustainable.
Exactly. And then there's the whole ESG investing trend.
Investors looking to put their money where their values are.
Right. So Hindware could get a whole new wave of investors if they can show they're serious about sustainability.
It's a win-win.
Yeah, good for the planet, good for consumers, good for investors. So as you're thinking about Hindware and their potential as an investment, look at their sustainability initiatives.
Are they reducing their carbon footprint? How are they managing their water usage?
Those kinds of things. Ask the tough questions, and it'll give you a much clearer picture of their long-term sustainability. And with that, I think we've reached the end of our deep dive on Hindware Home Innovation.
We've covered a lot. Their financials, their strategies, the challenges they're facing, the opportunities that are out there.
We've given you a balanced view, I think, of the potential risks and rewards of investing in Hindware.
It's really up to each individual investor to decide what they think.
So do your research, weigh the pros and cons, and always, always invest wisely.
Thanks for joining us.
Until next time, happy investing. We've really gone deep on Hindware, haven't we?
Yeah, we've really dug into everything, their financials, their strategies, even their approach to sustainability.
And, as we wrap up this deep dive, I think it's worth remembering that investing isn't just about, numbers.
Right. It's about more than just spreadsheets.
It's about the story. It's about their vision and their commitment to creating value over the long term.
And that's what makes Hindware so interesting. They're not just standing still, they're adapting and changing, trying to find their place in a market that's changing so fast.
There are challenges, though, right?
Oh, yeah, definitely.
A lot of competition, the market's volatile, and they've got that debt.
For sure. But they are taking steps. They're trying to become more efficient, streamline things, and reduce their debt.
It's almost like watching a tightrope walker.
Oh, I like that.
They're balancing those short-term problems with their long-term goals, and every move they make has consequences.
It's a high wire act.
Yeah.
And that's what makes it so interesting for investors, right? That element of risk and reward.
So what's the verdict? Bullish or bearish on Hindware?
That's the big question, isn't it? And there's no easy answer.
It really depends on what an investor's looking for, their own goals, how much risk they're comfortable with.
If someone's just looking to make a quick buck, Hindware's probably not for them right now. But if they're interested in this whole transformation story, if they see the value in, all the changes Hindware's making to adapt and be innovative, and if they're willing to stick with it, even if there are some ups and downs, well, then Hindware might be worth a look.
Yeah, I think that's a good way to put it.
At the end of the day, the decision is up to each investor.
But we hope this deep dive has been helpful, to give you a framework for how to evaluate companies and make smart decisions.
We've given you the tools. Now it's up to you to use them.
So do your research, ask the tough questions, and remember, the best investments are the ones you really understand.
Couldn't have said it better myself.
Well, that's all the time we have for today's deep dive on Hindware Home Innovation. Thanks for joining us. And until next time, happy investing.